All right, welcome everyone. So we are doing something a little unique this week for our market chat. So today is September 28th, and I have Ken Armstrong on board. So one of the founders of Elevate, and then Ethan Baker, certified financial planner. He is one of the new relationship managers here working with helping folks just guide on their financial plans, kind of work through the taxes, figure out, how to manage markets, all that. So with Shane out this week, we thought I'd do something a little unique, and we'll kind of let Ethan lead here. He's definitely an intelligent guy and very capable to handle this. So we're gonna let him take the reins and we'll walk through the Fed meeting, a few charts, and then what you should do with your financial plan. So with that, I'm gonna go ahead and turn it to the slide deck, and then I will let Ethan drive.
But getting started here, I know we wanted to definitely touch on the Fed meetings recap what was happening with the Fed meeting, since that has a lot of news points that we want to touch on. Tyler, Ken, which one of you would like to start off with that?
I think I'll take it. Yeah, the big thing here is people have been talking about this Fed pivot, and the Fed seems to have no intentions of doing so. And I don't think that's too much of a surprise. They didn't hike rates, but they're not going to hike every single meeting. They do want to let the data flow through. But the big one here I see is, inflation remains elevated. So they've won the war in terms of getting it down a little, but now it's sticky and it's actually started to come back up. Shane and I were talking about that in a couple of the prior, videos. And then the other one is here, they're committed to, returning inflation to the 2% objective. And right now they made some good headway, but now we're kind of stuck. And, I'm watching the 10-year right now and we'll get to that, but they're raising rates, but inflation is just kind of stuck there, and that is certainly a concern.
Yeah, Kyle, let me throw a thought in on that. I think Jerome Powell is fighting an uphill battle.
Mm-hmm.
And I say that because there are a couple of different things. And I know the Fed looks at the core rate of inflation much more than CPI because it wants to throw out volatile food and energy, yada, yada, yada. But I think he's fighting an uphill battle because he's fighting Congress because the nitwits in Washington are committed to spending ridiculous sums of money on things that really aren't productive, if you ask me. I won't go on a rant about exactly what that looks like. But the other thing is that those same nitwits, Dopey Joe and his band of clowns, are committed to killing the fossil fuel industry. And so you are going to have rising energy costs. We're already seeing it, right? We're talking about worldwide recession potentially, and oil is just zooming. Well, why is that? Well, it's a lack of supply. And so even though the U.S. has more oil and gas than the rest of the world, we're not able to utilize it because of our domestic energy policy. We're not investing in new projects or exploration. The government is making it very difficult for oil companies, energy companies to even get financing to do anything. So they're just using their existing supply. We're not building any new refineries. So as we continue to use energy and we're not investing in any new energy, and renewables, as great as they are, right, if they work, they only provide maybe 15% of our total energy needs, and the markets are trading as if the renewables are going to supply all our needs in 4 or 5 years. Well, that might happen in 4 or 5 decades, if ever, but not anytime soon. Mm-hmm. And so you're going to see increasing energy costs for quite some time. And that is inflationary. The government spending is inflationary. And so good luck to Jerome Powell getting back down to 2%. Who knows how high rates are going to have to go in order for that to happen.
And that's one of those, excuse me, difficult ones where you have, monetary policy, but the energy component of inflation, which makes up, I think, is about 15% or so of overall CPI, raising rates is only going to do so much. If there's no oil, people still need oil. So that part of inflation is going to be very challenging.
Very challenging. And energy is an input to everything. Very few goods or services that you can deliver without energy. And so if energy prices keep going up, that drives up the cost of everything else. So I wouldn't want to be Jerome Powell.
Nope. That is a tough battle to win.
And I
So,
know a lot of folks will read Shane's monthly commentary. One of the things he referenced was a direct quote from Jerome Powell in this meeting that we're recapping, where he says, "We're navigating by the stars under cloudy skies," which isn't the most inspiring thing to hear from the Fed chair. However, of course, no one can predict the future, but they being or not in charge, but being some of the leading folks on the economy and making decisions that directly impact the economy, this isn't the best thing to hear. And to add on to your guys' point about oil, especially with how much it's going up, you can't put more land off limits to oil production and then pressure banks not to lend to oil companies and then get angry that the supply is not there to keep the prices low. None of it is really syncing up together. So I agree.
Total madness.
Yeah, can you go back to that slide with the points from the Fed meeting? Thank you very much. Yeah, they're deciding to maintain the range for the federal funds rate around 2%. How long do you guys think, if you had to take a guess, it would take before we could get back to 2%? And what do you think some factors are in there?
I think that it's going to be years, not months. And the big one there is unemployment. So the only real way the Fed seems to work is you hike rates until hiring stops. And furthermore, then they start to, lay people off. Unfortunately, that's really how the Fed does it. And you really haven't seen that come through yet. So as long as the labor market remains strong, I think we're kind of stuck here for a while. And this has been going on for a while where we're hiking rates, and we saw inflation come down some, but now it's actually ticking back up. So I think this is a battle that's going to take years, not months.
I agree. And I got to have a comment for Shane. Shane, it took you, because I know he's going to watch this, it took you completely walking away from your computer and your trading software on your phone for the market to come to its senses and take a dump. I find that extremely ironic. You've been at it like nonstop for how many years now? With me, 10 years, 11 years. It took this for the market to come to its senses. I find that hysterical.
Yeah, it's too ironic. So you mentioned unemployment. You mentioned unemployment being a big factor in this. Inflation really seems to be here to stay, and now that it's spiking back up a little bit, it's already impacted a lot of different financial plans we've seen and the different reviews that we've had with some of our clients over the past couple of months. And I know a lot of people are paying attention to the different hikes or not hikes, but the hikes in the interest rates, wondering, are any rate cuts going to be coming in the near future? I'm curious to get your guys' thoughts on, these rate hikes and how they're affecting inflation.
So I'll take that one. The initial hikes certainly have had an impact, but now I think much like the Fed, it's kind of that wait and see approach for it to really come through. I know when I go to the grocery store, that hasn't gotten any better. And I also know supply chains aren't doing great. And I know one risk that has come up now is the government shutdown. So the infrastructure, we all remember COVID when, freight lines started shutting down, everything got really expensive. And now we're back in that situation where that might happen, where you shut down the government and then they're not checking customs, they're not doing some of those parts. That is not good for supply chains. And again, now we're at the spot where it's nice to hike rates, and that's what the Fed uses as their main tool. But in this case, now you're looking at a supply chain issue. So, add that on top of, price oil going up. It doesn't look so great for somebody who's just out there trying to raise interest rates to, take down inflation.
Yeah, he certainly has an uphill battle, and I think anybody who's thinking we're going to have a rate cut anytime soon is completely delusional. They were delusional through most of the year, thinking, "Oh, he's going to pivot." Remember that pivot? How many times did you hear pivot in a day? Pivot to what? Pivot to cutting rates? Not a chance. He made it crystal clear in his speech in Jackson Hole in 2022. We expect higher rates for longer. We realize we were wrong about inflation. It's not transitory, which is Fed speak for temporary. It's here to stay, and we are committed to bringing it back down to our 2% target. We're also students of history, and we know that if you make a lot of progress and then you take your foot off the gas, inflation comes roaring back and it's harder the second time. That's what happened with Arthur Burns, and which is why they had to eventually can him, and they hired Paul Volcker, who had to take interest rates to 20% 4 separate times to finally tame inflation. Powell wants to be a hero. He wants people to remember him for being the guy that killed the inflation in the early 2000s, 2020s. And so I don't think you're going to see a rate cut anytime soon. I think he mentioned on Wednesday last week, maybe a year out, September of 2024. I personally think it'll take until after that. The only way it's going to happen before then is if all of the market action is that we're headed toward a really nasty recession. He might cave to some pressure if inflation does come down because we're having a nasty recession. Ultimately, that's his goal, right? He can't come out and say that, but that's what he wants. That's how you kill demand. If that happens, then he might come around with a rate cut sometime in 2024, but I wouldn't expect one really until 25 or longer.
Right. Oh, I think Ethan's audio has cut out there.
Whoops, there we go. Do we have any other slides on inflation that would be good to show while we're still on this point about the interest rates?
I think so. This is the one on inflation. We'll certainly talk about what people should do with inflation in terms of the investing side. So get to that, but maybe we should go ahead and turn over some charts here.
Sure, let's do it.
All right. So this is one, a lot of people have asked this, and that's when I look at my portfolio, it's not as, has not gone up as high as the overall market. If you look at the S&P 500, that's market cap weighted. And what we're looking at here is the chart of the equal cap weighted. So what that means is that, Amazon, Facebook, Google, companies like that, those big ones, if you take their actual company value and use that as kind of a share of the overall index, they take up a larger share of it. So if they take off and they go higher and faster than the others, you can really have a distorted index. So this index kind of corrects for that. And it just shows overall 500 companies, how much they've gone up. And the answer is 0. So from the start of this year, we're looking at that here on this orange line. We're flat as of today. So it's been an interesting story in how you've got some companies that are really leading this entire advance, but on the equal weighted side, not much. And a couple areas just looking at here is this blue line's a 200-day, and you could still see maybe, the market comes down here a little more, maybe 3% lower. Worst case down to October lows, that's 10.5% lower. So we'll see on this, but it's an interesting dynamic when you look at the market cap weighted.
Kyle, you mentioned it's coming down near the 200-day. Would you mind expanding on why that's significant real quick?
Yeah, so the big thing, and this is part of that field of technical analysis, and the idea is you're just looking at price action. So company fundamentals and all that, that is something on the fundamental side. The 200-day matters because if you think of 200 days of history, that stays in investors' minds. So if you go below that, now that trend, the longer term trend is starting to go down. That gets people scared. That starts to hit places where they go from being profitable to being in the red, and they want to protect that profit. So that can really set off some selling. And that's what you're seeing here is that's really just a measure of long-term, price action. In this case, it's still trending up. We're still above it right now, but we've seen some of the most vicious selling occur below that 200-day moving average. So it's definitely an important line.
Yeah, so to summarize, this is the average of what the price has been over the past 200 days. People love to see that a price is above the average, And of course, as it stays above the average is going to rise. But as the price, gets closer to that average, it falls a little bit. For technical analysis people, the ones that are watching all the charts and making decisions based off of that, that's an indicator that they look for. And if it hits that average, and sometimes it can either bounce up, and that can be a signal that you should buy into it and it's going to keep going up, or if it breaks past the 200 moving day average, it could fall a little bit farther. So good, thank you for that. Ken, do you have any comments?
No, I'd say potentially a lot farther if it breaks through that. I think that we're in for some tough sledding. I don't want to be Johnny Raincloud, but all the everything we watch that would indicate the health and the direction of the economy is pointing down. So it wouldn't surprise me at all. We have seasonality, right? September, October, typically not great times in the market. We've got this government spending, political theater that's going on in Washington. We have student loan payments that are starting up again, beginning of October. I think the numbers are that per borrower, $400 a month of student loan expense. So it's going to take a lot of money out of the retail economy. And so I think we're in for some tough sledding for a little while, but it'll be curious to see what happens. I'm fully convinced that all these market indexes are going to come down to the 200-day moving averages, and what's going to happen after that, we don't know. I'm betting on them breaking through and going lower, but we will see what happens.
Yep.
Yeah,
and
especially to touch on. Oh, I'm sorry.
Oh, I was going to say, if we turn to the market cap weighted, one thing that accounts for is that those, there will be pockets in the market that lead us out of a recession, or a pullback. So it's important to always note, what those leaders are doing. But that's just, one thing I was looking at there.
Yeah, and I was just going to add, Ken, you mentioned the point of, the political drama that's going on. We're having debates going on. We're getting closer to an election year, especially around those times. Those figures want the economy to be looking good because they would prefer to have positive voter sentiment. Nothing to worry about going on here. And so news outlets, different things like that, they're going to try and be putting more of a positive spin on it. But if you look at the actual data of things, the equal weighted S&P versus the normal S&P, you can start to see a bit of the writing on the wall. I know in some of our review meetings, we've had a couple of clients ask about, why is performance like this when the S&P is doing this? Well, the S&P, if you compare it to the equal weight, is actually, not, or excuse me, the S&P is being really kind of buoyed up by a handful of different stocks that we're not overweighted because we're, properly diversifying here. I think that the equal weight is a much better indicator of how things are looking at the moment and how things are trending, and that's why it's an important one to keep an eye on rather than comparing things just to the nice and shiny S&P 500 and the SPY.
I think that's a good way of putting it. And something here. So this is the market cap weighted, and it's up year to date about 11%, and it's being heavily influenced by Tesla, Nvidia, some of these large companies that have gone on just really powerful runs, and not everyone owns those, and you wouldn't necessarily want to have a very large share of those in your portfolio, because just as much as they can go up, they can also go down dramatically. Tesla's a great example. I've seen that go down 50% a number of times. So when you look at it,
oh, I'm sorry, I didn't mean to interrupt.
Oh, so I was just going to say, when you see an index like this that is ahead of the equal weight, that's really what it's showing you, is that there's likely pockets in the market that are driving all the returns. Meanwhile, the majority of stocks are just kind of flatline. Maybe they're even going down.
Yeah, so I was just going to add in there, I apologize for interrupting, the S&P 500 SPY up this year, 11.4% year to date. Could you show me what the equal weight was up year to date so far?
So that one's flat, right back at where it started.
Exactly. So, let's round it down to a difference of 10%. If a difference of 10% in returns in a diversified let's put mutual fund, ETF, whatever it may be, the difference of 10% of returns is because of 5 or 6 stocks. It's not necessarily an indication of a healthy economy. I think in the commentary as well, Shane had put in the meme of Atlas holding up the world, but it was NVIDIA holding up the US economy. It's not entirely untrue. So,
Yeah,
Yep,
that's
that's a
an interesting graphic.
good point. And I'll say too, when you're talking about, well, where are we headed from here? The fundamentals look terrible. But if we just simplify things and look at this chart, what I tell people is we're sitting here where it would be normal and healthy to come back down on the SPY and retest this 410 level. That's 3% lower. But, big picture, looking at risk management, if we break this line here, you have the 200-day down here, 8% lower. But once you're down in this area here, this is where you can start to see that move where it comes back up and then comes back down. I mean, you have the COVID low down here at 220. I don't want to be a doomsdayer, but that is a level that's down there. So that's what you got to look at is, hey, maybe you're back or lagging by 10%, but it's driven by a handful of companies. There will be an opportunity where if you manage the risk now, you can get in later and catch all those that have not moved up that much. And you can make up for 10%, but what you don't want to do is be down 20, 30, 40%. So it's always important to just manage that risk and let the market tell you what it wants to do.
Yeah, Kyle, you made a really good point there. There's an old saying that says the market takes the stairs up and the elevator down. And the vast majority of clients of Elevate, their ages, begin with a 5, 6, 7, 8, and they're not at a point in their life where they are comfortable taking the roller coaster ride. And so our job is to keep them on the stairs when the market's going up, but keep them out of the elevator when it's going down. Or if they're going to be in the elevator, we rescue them after a floor or two. We don't let them go all the way down. So that's a lot of why we're holding, an excessive amount of cash. That most of that cash is invested in treasuries. It's a great place to hide, earning 5-ish% rate of return in a very safe liquid investment. And we're just waiting for the market to come to its senses, because as Kyle said, all the fundamentals look terrible. And if reason were to control the stock market, and it seems like reason is starting to come back around again, market should be trading for a lot lower. We're in a pretty rough spot, and valuations really are not all that far off of all-time highs.
That's right. And yeah, we'll turn to this chart, but yeah, on the fundamentals, that's really, digging into economics, company earnings, all that. And again, I'm somebody, I look at charts, and this chart right here is probably one of the scariest charts I've seen. We talked about an inverted yield curve being one, but now this is the 10-year yield. And this thing, I guess I wish I would have bought this chart and put all my money in that, because this thing looks bullish as heck. The only problem is this is, as I mentioned, the 10-year yield, and it has not been this high since 2007. And I don't know if you guys remember 2007, but that didn't end well. So, with rates going up like that, if this continues, that is something that will slow growth and likely spill over to the market, because when rates are low, people borrow money and they buy every asset they can. When rates get high, they don't borrow.
Nope, you should be paying down debt when rates are high, not accumulating more.
So that is the one chart where this thing, if it doesn't start slowing down, then I'm a little concerned.
Things are going to break.
Yep. So, with that, so Ethan, you and I were just chatting about this idea of where do you put money? Because sometimes there's this inclination that you should just earn something. So we've talked about treasury rates and they're over 5%, but if you factor inflation in, over here, this is the real rate of return. And if I were to ask you guys the question, if you can get a risk-free return for, under 2%, are you excited about that? Or how do you look at that in terms of where to park some money there?
Well, in my opinion, it's probably the best option currently, but I'd suggest that the current inflation rate is kind of a joke. If we measured inflation today like they measured inflation, when I was a kid, inflation be in the teens, not 3.7. So the people who do the calculations keep messing with how they calculate inflation to keep the peasants from rioting. So I'd argue we really have inflation that's considerably higher than what's on the chart. But assuming that what's on the chart is right, yeah, I think in today's world, one of the best places to put money is take advantage of the inverted yield curve and put it in treasury bills, 3 month, 6 month, 12 month, 1 year, 5.5% rate of return. I just I don't know where else to put money that you're going to do better than that and have liquidity.
Yeah. And I think,
and the return, by the way, is taxed from a federal standpoint, but not state and local. So you get an additional little bump on the return there.
right. And I think we'll touch on this later too, but always important to consider a financial plan overall because, this is a great place to park that bucket of money, but that's something we'll address in terms of, what bucket of money is this? It's not necessarily the sell every stock I own and go buy all fixed income. So we'll touch on that here in a bit. But
no, it's not, because the moment you do that, the market will have another delusional moment and go ripping higher. You know that.
Yep. And that's a big one too, is, the stock market can move 5% in a day. That's not a problem, but you're waiting a year to realize an actual 5% return.
Yeah.
So, yeah, now this is the big one. And I love this one. Just some history here. So we've got the data from 1928 to present day. And, looking at the S&P, we've got some treasury bonds in there. We've got real estate and gold. And, people ask this, they're like, well, I need to earn money now. There's got to be a better place than stocks, right? And when you look at this, what it's telling you is that stocks, they've returned the highest number. They've also had one of the largest drawdowns. Gold is the safe haven. And if you look at that, 6.5% average return. And in 1979, you got 126%, but you also had a loss of 32%. So pretty wild for, some smaller returns. What are your thoughts on this?
Well, I mean, if you want gold, you can always stop down by your local Costco and see if they have any any bars for sale there. I don't know if you guys.
No, you can't do that. It's only online. It's only online.
Oh, it's only online. Oh, excuse me,
Yeah.
my bad. I must have misread it.
And they're sold out. So good luck.
Exactly. And yeah, kind of touching on the overall financial planning point, these are the min and max, right? These are the bumper rails on the bowling alley that you're going to be trying to stay in the middle of, ideally on the higher side, trying to get some return. But it's good to look at the averages and see what these overall things are averaging. Yes, you see the S&P is the highest. However, again, this is from 28 to present. If we do the S&P average over 1 year or over a certain 10 years, it's not going to, like if we do it from 2007 to 2008, it's not going to look too great. And so, it is important to consider the time frame that you're currently in, and ultimately, what is the rate of return that you need for your plan before diving into one specific solution or into another, because it might not be the most prudent thing for you. Sorry, Ken, I think I cut you off there.
No, you're okay. I was just going to say, I think there's times to be aggressive and there's times to be defensive. And I think this is a time to be defensive. And so, anybody who thinks that in any given year they've got to go earn 7%, you're going to get your clock cleaned from time to time. Because there are times that you have no business investing to try to get, a market type rate of return. And so in my personal opinion, this is a time to be defensive. I wouldn't sell all my stocks. I certainly hold on to some of them. I love energy. I think energy stocks are a really sound place to be. I like property casualty insurance companies, the highly capital efficient type companies. If you can find some that are trading for reasonable valuations, those are the kinds of companies to own. And then honestly, I'm just going to go buy a bunch of T-bills because I'd rather hide out and make 5.5% than sit in the market when the market is feeling like it's on the precipice and just about to fall off a cliff. If we're proven wrong and inflation does come down and Dopey Joe decides that he's going to allow energy production, and we're not going to spend trillions of dollars trying to reduce the globe's temperature by half a degree, and we're going to stop spending so much money um, to make up for what consumers aren't spending, to make it look like everything's okay in an election cycle. If all those highly unlikely things happen and the market starts going up, then I'll change my mind. Until then, I'm going to be defensive, and I'll continue to own the right kinds of stocks, and I'm going to hide in T-bills.
Yeah, I think that's good.
And that's, yeah.
Something I was going to say here is when we look at the asset classes, just this corporate bond yield at 7% looks nice, but in a period like this where companies are going bankrupt, you have to remember that corporate bonds have credit risk from that company. So if that, company, they sell you a bond for 7 or 8%, it's nice to look at that and say, oh yeah, I have a, guaranteed rate of return. Well, if they go out of business, you lose everything. You can try to get that in court because you do have a claim to the asset, but 7% is not so great then. And that's where these T-bills, it's nice as a place to put some cash, earn some return, beat inflation. And then, when we're talking about stocks, the beauty of a stock is that if it's in the right place in a financial plan, is it gives you that long-term earning potential of 11.5%, but it's always, smart to manage that a little bit. So you do want to be a little strategic, but also, foregoing some of these opportunities, especially corporate bond in a recession, can set you up to better take advantage of these longer term opportunities to, earn some good returns.
Yeah, Kyle,
Yeah,
question for
I
you.
completely agree. And just a real quick go. I mean, the thing to keep in mind, I know we've been talking about, there is, a recession coming up, whether it happens next month or in a couple of months, that it's necessarily going to be coming next. And we are, speaking more negatively on things than positive, instead of saying things are all looking so great, we're talking about a couple of different negative things. But that doesn't mean that everything's all bad, because the economy, if you zoom out, it goes in 4 different phases, just like the 4 seasons, right? Right now we're in fall, so every single time after fall comes winter. Well, once winter comes, and it necessarily comes, spring comes after that. So is it smart to be defensive now? Yeah, because winter's coming. Buy yourself a coat. Don't freeze to death. But keep in mind that if you have the time within your financial plan, spring is going to come right after that. And so it's important to make sure you keep in mind, how much should I be allocating towards something that's safe, for the T-bills, for my emergency fund, for things like that. How much should I be allocating for my long-term growth, and how should I be managing that specifically, and as well as, a medium-term bucket kind of in the middle. So just adding on to what Kyle was saying, that it's important to keep all of that in mind when you're looking at this, and not just think, oh man, everything's going down the drain, because it eventually comes back around.
Right. And I think that's something where, if asked the question, will the stock market be higher 10 years from now? I would say I give that a 90% shot. Yes, long term, it's probably going to go higher, and it probably will offer the best rate of return. But this is winter coming, maybe. So maybe just play a little defense, manage the risk, and set yourself up for that long-term success. And, try not to be pulling those assets out and, I guess, depriving them of that opportunity to experience some of that upside that's offered in the stock market. And I think with that, Ken, are you ready? Maybe we can talk about kind of income plan, how all of this comes together to, be successful when you're doing that.
Well,
Absolutely.
Ken, did you have a question to ask Kyle before we jump over to that? I noticed you mentioned that.
No, I was just going to say that is that 11.5%. Does that include dividends reinvested? Because I've seen long-term numbers that are closer to 9. I'm just curious.
Yep. So that does, and I think the time period is relevant on this one. So this is from 1928. You can go back a little further on that data, and I've seen 8%, kind of like you're saying, 8.5% has been more of a typical number. So
yeah, okay. I'm just
right
curious.
in there.
It looked a little high.
Yeah, but I think the big one there is down 43%. That was 1931. So bad year there. And then I just want to hit on this: gold, when it was up 126%, That was in 1979 with inflation at 14%. And interesting world at that time. That's why, Shane and I always talk about it. Gold is viewed as a chaos hedge, not an investment. And that's why.
Yeah, I agree with you.
Yeah.
All right. So Ken,
onto the income plan.
You are the expert on this. So Ken, I will let you lead this. But how does this kind of fit into how, people should think about the markets overall in the context of their plan?
So I think everything up until now we've been talking about for people that are not retired and not going to be retired, in the next few years, perhaps, right? They still got a few working years ahead of them. But for people that are already retired or going to be retired soon, you want to start setting up a game plan, because when you stop working, guess what happens? Well, paychecks stop. Right? Not necessarily paychecks. If you own a business and you sell the business, right, the income stops. And so you need to then turn what's on your balance sheet into income. And how do you do that? Well, the world would have you think that adopting what's called the systematic withdrawal plan is the best way to go. And it goes like this. Advisor says to client, Mr. Client, here's what you need to do. Well, first of all, you need to decide how much money you can scratch out a living on, and you need to leave all the rest invested with me. Well, guess who's that is good for? That's good for the advisor and that's good for the firm. It may not be good for the client, because a systematic withdrawal plan is simply where you take money out of the market. You basically tell your advisor, hey, deposit 10 grand in my checking account every month because I need money to buy groceries and go do what I want to do in retirement. And so your advisor is going to go sell shares every month and deposit 10 grand. And that works okay when markets are going higher. But when markets are going lower, that's financial suicide, because every time the market goes lower, he's got to sell more shares to produce that same 10 grand. And so you can get into a situation whereas if the market's, poor for long enough, even when there's a nice recovery, your income is still declining or your account balance is still declining because you don't have enough, there aren't enough shares in the account, even given a higher rate of return, to throw off the income you need and grow the account balance. And so that leads to a death spiral. And so this plan does not allow for that. This plan is built intentionally to make sure that even if people live a long, long time and markets are poor or inflation is high or all kinds of combinations of things, they still get to live with dignity. And so we'll begin with the end in mind. If we go down to the bottom right, it says retirement income. So I'm going to take you through a very simple example. I'm going to call it 10 grand of total desire for dollars in the checking account every month, right? And so we're going to say 5,000 of that is need and 5,000 of that is want. So you're going to fund your needs differently than your wants. You're going to fund your needs with highly reliable, if not guaranteed, sources of income. Things like on the screen, Social Security, rental real estate, perhaps, income annuities or pensions, things of that nature. And since we're talking about inflation, I would say that in this case, Social Security, it does have a CPI indexing factor. If you're a landlord, you might want to write some kind of CPI increase into your leases. And on the annuity side, if you're going to go do something like buy a very simple single premium immediate annuity or a deferred income annuity, we're not really big fans of any others than those types, because the other types are very expensive and they promise the moon and they deliver very little. Kind I just mentioned are very, very inexpensive and they are very reliable. You can get them with inflation factors. So you may want to include an inflation factor in there. And the idea is that if my need is 5 grand and I set up my world so I have 5 grand a month of income coming in, I can meet my needs, right? So that 5 grand of income coming in from those different sources, that goes into this cash reserve. The other thing you start out retirement with in the cash reserve is more cash. So we ought to start out retirement with, say, 2 to 3 years worth of wants money. So at 5 grand a month, that's 60 grand a year. So start out with, say, $120,000 to $180,000 in the cash reserve. So let's pretend it's, month one of retirement. You're sitting on the beach in Maui. You're sipping an umbrella drink and you pick up the Wall Street Journal and it says the market dropped 30% yesterday. And you're thinking, man, that sucks for somebody, because I hope it doesn't impact what you have for dinner that night. because you've got 3 years of all your expenses taken care of, right? 5 grand a month is going to come in from the income sources. You're going to pull 5 grand a month out of the cash, and you're going to have your 10 grand to go live your life and have fun. Eventually, that market's going to recover, and you will also have drawn down your cash reserve. And so what we'll do is go sell something that's in one of those buckets up on the upper right, and we'll replenish the cash reserve, and then you go back to just enjoying yourself. Probably a smart idea to make sure that cash reserve is giving you some rate of return, so we can build you a treasury bill ladder that, money, treasury bills mature for 5 grand every month for the next 2 years or 3 years, whatever you want to do. But that's the right way to build an income plan, because even if the cash reserve went away and all the buckets of money in the upper right went away, because again, markets were too poor, you lived too long, you still get to live with dignity. Why? Because you've got all the needs covered with highly reliable or guaranteed income. So you never have to ask your kids to live in their basement and give you an allowance, and you never have to shop for groceries at Petco.
Perfect. Well, Ethan, you have any questions on that? I think Ken, great job just explaining that. And, I like this plan, staying away from that idea of watching the stock market every day in retirement, but instead make sure you use those other vehicles to afford yourself time so that you don't pull money out of the stock market when it's down.
Yeah. And one more thing, Kyle, I just forgot. I didn't elaborate on it a little bit. So let's say we set up this plan and we're 2 years into it. He started out with 3 years of cash in that reserve account, and market's still going down. And you're thinking, oh man, I'm getting nervous. I only got 1 year worth of cash reserve left. Well, one thing we certainly can do is go and look at the buckets, and we can find something that has done well, something that's actually gone up, because your investment portfolio should not be full of assets that all move in the same direction at the same time, right? You build some diversification into things. And so what we would do is, instead of just wholesale selling a bunch of stocks to fund your cash needs like you would have in a systematic withdrawal plan, we can go in there, we can find that which has done well, we can liquidate some or all of the shares in that thing, replenish your cash reserve, then maybe rebalance the portfolio a bit. And now you've replenished your cash reserve, but you've done it in a way that you didn't suffer a loss. You actually just cashed in on gains. And it's because we don't do this systematically every month. We do it tactically and periodically. We use the market when it serves you. Most people get used by the market because they don't know how to plan. We know how to plan. We can set it up so that you get to take advantage of the market instead of the reverse.
Well said.
Exactly. If I invest into a stock at $10, I'd rather sell out of it when it's at $18 when I want to do something, rather than need to sell out of it when it's worth $7.
You got it.
And I think your example is great, Ken, because if you're sitting on the beach in Maui and you pick up the journal and everything's down 30%, well, if your dinner is guaranteed to be taken care of by your Social Security, by your annuity, your pension, real estate income, whatever it may be, well, that's fine. You just might need to cancel your flight for the second trip back to Maui, later that year, because that's something that you want to do rather than you need to do. Whereas if it's the reverse, and you are needing to pull out of your account to afford dinner, to pay for your groceries, things like that, you're causing yourself unnecessary stress. And when you're in retirement, that's something that makes no sense. You worked all your life to get to retirement, and now you're still dealing with stress. Like, it makes zero sense to continue doing that. So taking care of your needs, your guaranteed income, covering those needs is a great way to de-stress retirement and make sure that you live a happier rest of your plan. And taking care of the ones out of the things that are more variable, like with the market. If the market's up 10, 15%, great. Now I can go on an extra vacation. If it's going through a time like right now, well, maybe I don't need to, travel over down to Florida or wherever it may be. Those are, as the market ebbs and flows, so does the financial plan, and so does, your plans in your life. So, this is why we put something like this together, to show that by diversifying your income between Social Security, annuity, pension, real estate, as well as diversifying it between your needs and wants, really helps your financial plan be successful for the long term.
Yep. And I think a big one here is, so then there's this question, and it's what we're seeing now is with inflation where it is, what is the best tool to combat inflation?
I
I
think
mean, Ken, you
historically,
kind of,
yeah,
yeah, you mentioned it earlier, so please go.
yeah, I think long term, the best hedges against inflation are common stocks and income producing real estate.
Yep.
But you got to buy them at the right price.
Right price and then the right bucket, right? So if we own those in the right bucket, you have time and you can let those experience some of the ebbs and flows, and over time, not only beats inflation, but builds some real wealth.
Yeah, yeah.
Exactly.
So,
Because if
go ahead.
I was just going to add in, because if we look at a healthy company, or if we look at a piece of real estate, a healthy company is going to, it's going to go up and down. The stock price is going to ebb and flow with the market because people are buying it and people are selling it, depending on what's going on in their lives and what they're trading. But overall, if it's a healthy company, it's likely going to rise with inflation because, people are likely going to keep buying it. Same thing with real estate. It's land. It's probably useful for something, especially if it is income producing real estate. And so that's going to keep up with inflation because it's going to keep increasing the price because it's something that people still want. And so that's how things like that keep up with inflation. I know, Ken, you mentioned earlier, like energy stocks, different good, solid companies with clean balance sheets, things like that are great ways to hedge inflation. Um, uh, I was going to touch on one last point, but it kind of evaded my mind. But ultimately, you want to keep, if you're investing into something to keep up with inflation, it needs to be something that is, people are going to ultimately want to continue buying regardless of where the overall economy is at.
Absolutely. I can't wait to go buy a giant chunk of Hershey stock. Right? Hershey is one of the most capital efficient stocks on the planet. Let me ask you a question. What do you think the likelihood is that your great grandchildren are going to be eating Hershey bars?
Very
Quite,
high.
Pretty
yeah,
high,
very
right?
high.
Pretty high. Hershey has something like a 70% return on investment. It's incredibly high. It doesn't cost very much to run their business. Their biggest inputs are labor and some marketing. And if we do have continued inflation and the cost of a Hershey bar goes from 75 cents to $1, are people still going to buy it? Yeah, they're still going to buy it. In fact, they're probably going to buy two because they're depressed about the inflation. So that kind of a business that is very, very capital efficient, that rewards shareholders with dividends and buybacks, that has a very, very solid market position, that doesn't have to go invest huge sums of money like a mining company does, for example, before they even stick a shovel in the ground and hope to find something of value. Those types of stocks are very um, they're the best stocks in an inflationary environment. They are going to be able to continue to raise prices and make a profit regardless of what happens.
And just a quick disclaimer, Hershey is an example of a clean company that has done well over time. That is not us encouraging you to go out and put all of your money into Hershey because it's a good
No,
company.
no, no, no.
It's not a recommendation like that. So please
I
don't
was
take
being
it the wrong way. That
sarcastic,
is
but I
just
do
an
want to go
example.
buy a big slug
Yeah.
of it for my personal account.
Yeah, it is. Sugar is one of the most addictive substances out there. So,
Absolutely.
Mm-hmm.
but
Great.
perfect. Well, I don't, with that, anything to add, or should we maybe cut this off? And speaking of candy, and I'm thinking our next chat's going to be in October here, so Halloween's right around the corner.
Mm.
Yeah, so go survey of the candy your kid takes home, how much of it was made by Hershey.
That's a great channel
Maybe we
check.
can get
So
Shane to wear his Halloween costume to the chat next month. No, I don't. I don't have any other comments to add. I think we've covered pretty much everything, especially with what's been happening with inflation, the overall interest rates, where the economy's headed, but also the big picture of where it's going to be going after that because of the different phases. And ultimately, if you have questions about where things are for you with your current plan, if you're listening to this, or if you just want a review of where everything is at, please let us know. And we're planners. We're more than happy to take a look and help you figure out the best way to set things up for yourself.
yep.
Cool.
So
Thank you.
perfect. Well, Ken, Ethan, thanks for taking the time to sit down with us today, and hopefully we'll get you on again soon.
All right. You have a great day.
All right, take care.
Thank
Bye-bye.
you.